my name is David Lynn. I'm part of the research team at Altair, and I just wanted to welcome all of you and say it's great to be here live with all of you in person. You know, typically, when the equity markets are down 15% or so, that's probably all we would be talking about, right? Bonds would probably be doing fairly well. But unfortunately, our steady Eddie bonds are also down about 15%, as Jason mentioned, and that's really unprecedented. It's the worst year on record. And so, given all the chaos that we're seeing in the bond markets this year, it really only made sense to have one of our recommended bond managers to be with us today, and that is Gannett Welch & Collar. GW&K is a Boston-based firm that manages around $45 billion in assets. They've been helping us manage muni bond portfolios for more than 25 years. And today we have Cara South with us. She's a principal at GW&K. She has more than 16 years of industry experience. She's a portfolio manager across all of their municipal bond strategies. And she's going to help us kind of dissect what's been going on in 2022. So, Cara, welcome, and let's jump right into it.
Yeah, thank you for having me.
So, Cara, maybe we can start with, let's talk about 2022, which is such a unique year. Maybe to get everyone on the same page, maybe you can frame what has happened in the bond market this year, not only on munis, but also on the taxable side, and then we'll kind of go from there.
Of course. So it's been an extremely challenging year for all fixed income markets. In fact, it's been the worst bond market that we've had in over 40 years. And it's been a rate-driven sell-off just due to the high inflation and aggressive Fed policy that we've seen. So really, no matter where you've been invested in fixed income, and this is looking at the broad indices, you're looking at negative double-digit type of total returns. So you have the U.S. Muni Index down 11% year to date. You have the U.S. Treasury Index down 13%, and you have U.S. investment-grade corporate bonds down 17% year to date. And really, the longer your duration or the more sensitive you were to interest rates, the worse your performance. And I think a good example of this is if you look at the 30-year Treasury, which is AAA rated and has no credit risk, is down 35% year to date. So it's really been a tough year across the board. And what's made this year different than prior years, in addition to the rapid rise that we've seen in rates, so you have Treasury yields up 200 to 350 basis points across the curve in a 10-month period, but really the larger factor has just been the low rate environment that we started at. So you figure we ended the end of last year with a 10-year Treasury yield of 1.5%. So when you think about the return on a bond, you have two components of return. You have your coupon, which is fixed and is set at the time of issuance, and then you have your price return, which is going to fluctuate based on changes in interest rate, but you ultimately get par at maturity. So what's happened this year is because we started out with such low rates, it wasn't enough to offset that negative performance. So there's been periods in the past, if you go back to 1980, back to 1994, where we've seen similar types of increases in yields. But at that point, the starting yield was so much higher, it was able to offset it. So I think 1980 is a good example of that. So in 1980, the 10-year Treasury yield was at 10%. So even though you had negative price impact with the rising yields, it actually you had a positive return for the Treasury market overall.
Okay, so it depended it's not just that the rates went up, it depended on the pace that rates went up,
yeah.
And it also depended on the starting point where yields were at the time.
Exactly.
Okay, so given that inflation and interest rates are driving this market, especially in 2022, can you talk a little bit about how GW&K views inflation moving forward, as well as any thoughts on the Fed and their interest rate policy moving forward?
Sure. So I think it's helpful to back up a little bit and just look at what the market was expecting at the beginning of the year, which was for 3 Fed hikes for all of 2022, or 75 basis points. And then you look at where we stand today with the upper bound on Fed's funds at 4% and the market expecting another 100 basis points by the spring of next year before we start to see cuts in 2023, 2024. The Fed has been very clear that their number one priority is making sure that they get inflation under control and back towards that 2% target. So as Jason mentioned, the data that we've had recently has been supportive of that. So you have the month-over-month core CPI at 0.3%. So if you look at that over, kind of annualize it, you're looking at 3.6. So it's definitely directionally headed correct. But again, to what Jason mentioned, if you look at the components of CPI, you've had goods inflation come down a lot, but you still have services inflation that's remained high. And that's more closely tied to wages, so it could be a little bit harder to tame. I think the market this summer got a little ahead of itself and expecting the Fed to pivot. And from my perspective, I still view that to be one of the biggest risks is, the market sees some of this more favorable data and starts to expect the Fed to reverse course. And it's important to keep in mind that a slowdown from the Fed is not a pivot. In our strategies, we don't look to forecast interest rates or predict the direction of interest rates. We look to take advantage of what we're seeing in the market based on changes. So we look at the absolute level of yields. We look at the slope of the curve. But in our perspective, it can be very difficult to get that correct all the time. And I think this year has been a good example of that, just based on how much market expectations have changed. Maybe one other point I would just make is even if the Fed does continue to hike rates, the front end of the yield curve, where you think of a 2-year treasury, is going to be very sensitive to what the Fed's doing. But if you go further out the curve, say in a 10-year maturity, that's going to be much more sensitive to expectations around growth and inflation. And so if the Fed is more aggressive in hiking front end rates, you could actually see long-term rates come down more. So just something to think about.
Great. Thanks for providing all that color. Let's talk a little bit more specifically about munis, since that's really your expertise. Can you elaborate a little bit more on what's been going on in the muni bond space? And what is really interesting to a lot of people is how much better it held up than U.S. Treasuries and investment-grade corporates and so forth. So maybe you can talk a little bit about why that was.
Yeah, a couple of factors I would highlight. One is just the tax exemption. So if you look at muni yields relative to treasury yields, that ratio is typically about 80%, meaning that a muni yield is going to be about 80% of the treasury of the yield of the treasury. So when you have treasury yields, say, go up 100 basis points, you're only going to have muni yields go up 80 basis points. And so therefore, you typically have municipals outperform into a rising rate environment. The other factor that's been supportive of our market this year is just supply. So supply is down year to date, and more recently it's been extreme. So in September and in October are typically pretty heavy months for us from a supply perspective, but this year we've been down 40% on a year-over-year basis. So you just have more demand chasing fewer bonds, which leads to tighter yields. And we have seen a lot of outflows, mutual fund outflows within the muni market this year, but I would say that demand still remains very strong. And the place that we see that is in the new issue market. So if you look at deals that are pricing, we see them multiple times oversubscribed, meaning more demand for bonds than they're going to be issuing, and that leads to better pricing for issuers.
Got it. So we've kind of all seen this around in the economy, but clearly growth is slowing. Mm-hmm. It's possible that we have a mild recession looming. A lot of investors are a little bit worried about how state and local governments are going to hold up. Mm-hmm. If in fact we do enter a recession in the next 18 months, 2 years. What would you say to those investors?
Yeah, so from a fundamental perspective, munis remain very healthy, and that's partially been driven by the strong revenue growth that we've seen and the record level of reserves that have been built. What I would add to that, and I think is different now versus say a 2008, 2009 type of time frame, is just the federal support and stimulus that was received during the pandemic. And that has really allowed municipalities to shore up their balance sheet, to contribute to rainy day funds, to make additional pension contributions. So fundamentals are in a really good spot within the muni market. One thing that we track is just the upgrade downgrade ratio. So that's looking at changes in credit rating. So if the rating agency lifts the rating, then you're getting an upgrade, and the reverse for a downgrade. And if you look at the ratio through the first half of 2022, it was 16-1, meaning 16 upgrades for every 1 downgrade. And that just gives you an idea of the trajectory that we've seen. And you can include the state of Illinois and the city of Chicago in that upgrade camp. So Chicago was actually upgraded last week from high yield to investment grade. So there's been a lot of that, and that's just reflecting the overall direction that we're seeing. The other thing that I would mention with municipals, it's a very high quality asset class. So we're a high quality manager within a high quality asset class, but in general it is a very high quality area of the market. One way that you can look at that is if you look at historical default ratios. So if you go back over the last 15 years, the default ratio for munis is close to 0. If you compare that to the corporate market, it's around 2%, which is still a very low default rate over a 15-year period. But probably what's more interesting is if you look back to the 2009 time period when corporate defaults were around 6%, munis were still close to 0. So it's just it's a high quality part of the market.
Great. So Cara, most of the people in this audience have GW&K muni portfolios. What would you tell them about how you're positioning your portfolios today, and where are you seeing some of the biggest opportunities?
Yeah, so we are always looking to capture a higher yield within our client portfolios. So what that has meant this year is we've been looking to sell some of the shorter duration bonds within the portfolio that have held in relatively well and are what we view to be more expensive. And we've been buying bonds further out the curve that we view to be relatively cheap and picking up incremental yield. So on those buys versus the sales, we're picking up 80 to 100 basis points of yield. So this year, we've really seen investors pile into the front end. So sort of 5 years in as people have been concerned about rising rates. And what that led to in the muni market was really tight muni treasury ratios. So that's our best indicator of relative value. So this summer that got as tight as 55%, which actually doesn't make any sense, but that's where people were really buying. So we're always looking to sell into that. So we were selling those bonds into those really tight valuations and buying those bonds further out the curve. So that's what we have been doing so far this year. As far as like sectors or more on like the issuer side of things, I would just mention on the supply side, we've seen a lot of issuance from states like New York and Texas. So we'll look to take advantage of that when they flood the market with supply, and we're able to pick up some incremental yield for the higher credit quality.
Got it. So when we talk to a lot of our clients and just read a lot of the research that is out there, we know and hear that bond investors are generally frustrated with the returns because of what has happened in 2022. Mm-hmm. It's really taken away a lot of the total return that we've seen over the last several years. So if you look at like 5-year total returns on an annualized basis, it's pretty much flat. If you look even 10 years out on an annualized basis, bond returns are maybe 1% on an annualized basis. And so what would you say to a bond investor about sticking through it and why they should continue to hold bonds in their portfolios?
So I would say as a long-term investor, you actually want interest rates to increase. And the reason for that being is you're able to take that coupon or that income that you're receiving and invest it at higher and higher yields. And what that means over time is that your effective rate of return will actually be higher. So the biggest component of bond return is actually that reinvestment rate. The other thing I would highlight that's different between bonds versus stocks is that unless there's credit impairment or you have a default, you're always going to get par at maturity. So the price path that the bond takes between the time that you buy it and the time of maturity is irrelevant, since you know that that is what you're going to get. So a stock price might stay depressed indefinitely, where you know a bond is always going to go back to par. The other thing I would add is from a yield perspective, when you purchase a bond, you lock in that yield at the time that you buy it. So periods in which you see negative performance are going to be offset in the future by positive performance until the yield converges to the yield that you locked in when you bought it. So the key to all of it is to make sure that you stay invested so that you're able to have that recovery back to par. And so I think just keeping that in mind, we view this to be a really attractive entry point into the muni market. Yields are higher than we've seen in over a decade. So you have to go back to 2009 to capture these type of yields. So we think this is a good entry point. Maybe just one way to look at it too is if you look at munis, say, versus other taxable alternatives, what we use to compare is we look at the tax equivalent yield. So for an investor in the highest tax bracket, even though, say, the yield to worst around for a AA muni right now is around 3.5%, if you adjust that to compare it to other taxable alternatives, it's actually closer to 6% because you have that tax benefit. And so for a high quality asset class, we view that to be a really attractive yield. It's comparable to asset classes with lower credit quality.
Great. So it's a good time to be a bond investor, right?
Yes.
Okay, great. I just actually realized that we're pretty much out of time, and I wanted to save enough time for people in the audience and those that are online to ask questions as well. So we're going to be passing around some of the microphones there. I'll also ask Jason Laurie to come back up to join us in the event that any of you have any questions for him or myself. So feel free to ask any questions. We have a question up here. Do we have a microphone, Anna, for? Okay, and I will repeat the question for those that are online.
Yes, the question I have, a lot of projects seem to make it through the midterm elections where a lot of projects across different states were approved, and it's quite an initial amount of supply potentially. How long does it typically take to see that come to market? When what's the time span typically look like? In kind of a generic form. I'm sure it varies by state, but what would be your historical point of view?
Yeah, so the question was related to a lot of the bond issuance that was approved during the midterms. And that we've seen, like New York passed a really big climate project. So that's going to be about $4 billion or so that they'll be bringing to market. You saw a lot of issuance that's expected from school districts. But I would anticipate it to take a while to actually come to market. So probably like the end of next year or so. But in aggregate, it is a pretty big number. So it was about $60 billion or so that's been approved. So it'll be interesting to see exactly when it comes, but I would expect it to be a little while.
Anna's funneling all the online questions, so we'll go back and forth.
You can repeat it after I ask so that people online can hear. But it's given that munis are mostly owned by retail investors, won't massive outflows continue if the economy weakens?
Carl,
can you repeat the question, Jason?
Sure. Or yeah, so the question was related, will outflows continue just given that the muni market is a retail dominated market?
Because I think it's been over 100 billion so far in 2022, right?
Yeah, we've had a record amount of outflows within the muni market, given that it is retail dominated. So it actually reversed all the inflows that we saw last year. So we had 100 billion of inflows last year when rates were near all-time lows. And we've had outflows into a rising rate environment, which is actually the opposite of what you would want to do. So as far as, you know, people getting back into the market, I don't know exactly when they will want to do that, but from a performance perspective, you actually want to get invested in the market. Typically, performance will turn before fund flows do. So you'll continue to see muni investors exit the market, but performance will be getting better. I would say that retail investors do tend to be very sensitive to negative performance, and it's actually the worst decision you could make, but people don't like to see negative returns.
Mike, did you have a question?
Yeah, I think people understand if you hold a bond to maturity, you're going to get your money back. But then people see in their portfolios the managers selling those bonds and realizing the loss. Can you give an example of why you would do that in an environment where just simply holding would return your money?
Yeah, so
Can you repeat the question?
sure. The question was related to, you know, you get par if you hold it to maturity, but you'll see managers sell a bond that's at a loss prior to maturity, which we do in our portfolios if we're able to find a more attractive alternative in the market. So you figure the loss that's embedded in that bond, you're not losing if you sell it and buy something that's underperformed more. So you're kind of like capturing both. So that's why we're always looking to sell bonds that are relatively rich and buy bonds that are relatively cheap. So if you buy a bond that has a 5% say yield, or you sell a bond that has a 5% yield and you buy a bond that has a 5.4% yield that's underperformed more, you're capturing that loss plus the higher yield. So you're capturing the loss and then you purchase as well. And you're capturing the higher yield.
Other questions in the off or online, Anna? Any?
Given your views, what changes have you been making in portfolios?
Okay, yeah, so the question from online was, given our views, what changes have we made in the portfolio? Really, the portfolio changes that we're making right now are, I mentioned on one of the slides about the 6-month treasury being attractive at that 4.5% level. Kara talked about the front end of the curve being the most impacted by the Federal Reserve. And so for a portion of our taxable bond exposure, not the munis, but on the taxable side, we're moving, have moved and continue to move those into short-term 6-month treasury. So we are just in the process of doing that as we speak.
About roll, which we look to capture in our portfolios. So what roll reflects, it's a natural appreciation of a bond as it rolls down the yield curve. So thinking of a 9-year maturity bond going to an 8-year maturity bond, you're going to naturally have a yield decline, and that leads, when you have yields down, price up, and that results in a natural appreciation of the bond. So we'll look to capture that in our portfolios, which you can only do it as an active manager, and that contributes to our expected return. So if being your return, assuming no changes in interest rates, you would add that roll to look at what your expected return would be over a 1-year time period. So for example, if the yield was 3.5 and you had roll of 30 basis points, you would have a 3.8% expected return as we capture that natural appreciation of the bond as it declines down the yield curve. Yeah, so for our intermediate strategy.
Can you repeat the question?
Oh, sure. What is the yields on our strategy, which right now is close to 3.5%. So I actually used the actual yield as it currently is, and the current roll is expected to be around 30 basis points. And again, another way to think about it with munis is to do that tax equivalent yield, so adjust it for the tax rate. So again, that's going to get you over 6% if you adjust it for the highest tax bracket, excluding the state tax rate.